Right. Good afternoon, good evening, good morning, wherever you are in the world. Welcome to today's 90-minute blockchain workshop. 90-minute means that's the longest amount of time I might talk for, but I'm trusting and hoping to get through the list of content in less time. Now, if you're watching this live, welcome to the call. I've already seen in the Q&A box, we've got Sweden, we've got South Africa, we've got USA, we've got Canada, we've got Spain, Italy, Germany, all joining us here on the call. Cambodia as well, welcome. If you're watching this as a recording, the date today is the 10th of August, 2026. And so if you're watching this and it's the month of September or it's the year 2030, you're potentially watching outdated information. And so I want to encourage you to reach back to the person who's shared this workshop with you and ask for the latest training, the latest workshop, the latest information. What I do want to say before we dive into this is that this is an interactive workshop. So I will be asking questions. I'll be asking for your feedback. And when I do, please go to the Q&A box, click on it, and give me your honest reactions, your honest questions, your honest responses. It makes this a lot easier when we are engaging with one another. And I will stop after each section and allow for some key questions. So if there is a question that pops into your head while I'm talking, just write it down. I'll stop for 2-3 minutes in between each section, give time for some Q&A, and that would be a great time to then ask the question. I want to put a big disclaimer in front before we dive into this. A lot of what I'm sharing tonight is my views, my opinions, backed up by data. So I will be sharing sites, I'll be sharing information, I'll be sharing stats that I trust that you will go and double check for yourself. So every time you see stats, data, information, it'll be directly from a website. You'll be able to see the website address up in the top left corner, and you can go and form your own opinions, form your own information from that. I really want to encourage you to do research. Again, I'll be sharing my own opinions based on this data. So it really is a learning opportunity, and that's why we do these workshops together. So let's dive into it. Question 1, when did you first hear about Bitcoin? What year was it? And while you're in the Q&A answering that, I can tell you, I first heard about Bitcoin in 2016. That's the first time that someone came to me and said, have you heard of this thing called Bitcoin? And this particular gentleman has become a very close friend of mine over the last decade. We got to travel in and out of the United States. We ended up mining Bitcoin and Ethereum and Zcash and Monero and Expanse and some of these other coins. And that was where we started, right at the foundation of this core infrastructure, mining. And then slowly we got more and more educated and involved in things over time. So let's have a quick look. Some people 2010, that's amazing. Dennis, 2016, 13 years ago. Pierre, 2017, 2014, 2020, that's quite recent. 2009, so basically when it launched, Brad, you were right at the coalface on that. So let me ask a second follow-up question. Did you buy Bitcoin when you heard about it? In 2016, when I sat down with this good friend of mine and he showed me Bitcoin mining, I started mining Bitcoin that same year. I got involved in buying up hardware, buying up infrastructure. I was mining Bitcoin before it got to the $10,000 price range. We were mining it at a couple $1,000s at that point, 1,000, 3,000, 6,000 a bit later. But it hadn't gone to 10, hadn't gone to 30, had definitely not gone to 100,000. And the biggest mistake I made is I used it for cash flow. I was mining Bitcoin, and as fast as I was mining it, I was spending it. I'd bought this infrastructure. I'd bought what I believe was an ATM, this processor. And as this ATM, this processor was creating Bitcoin for me, I was turning around and spending it on rent, on cars, on school fees, on groceries, and all the normal things we need to live. I wish there'd been a workshop that I'd sat in and someone had explained the tokenomics, the infrastructure, the technology in a way that would have changed my action and changed my decision-making, because I would not be sitting here on this call if I had been sitting on all of that Bitcoin. Here's the good news. We're sitting in a a new wave of technology in blockchain that allows us a second chance. And we're going to talk a little bit about that today. But let's first go and look at Bitcoin's blueprint. Let's look at Ethereum's blueprint. If we understand their blueprints, if we understand the core mechanisms for their success, then we can take those core mechanisms and we can replicate it again. Does it make sense that right now when you go onto the road, there's about 100 different car types and companies, etc.? Why is that possible? Because a handful of people in the early days started replicating best practice, and here we sit 100 years later. I mean, car technology is only 100 years old. Here we sit 100 years later with all these different variations based on learning blueprints and improving it. So one of the fastest ways for you to win, one of the fastest ways to you to accelerate success is to look at the blueprints and then replicate that as well. So let's go look at the blueprints together. I'm going to share my screen with you. And again, every time I share my screen, please take note of the sites that I'm on. You're sitting on charts.bitbo.io price. Okay, so I've gone in specifically to look at the Bitcoin price from 2009 all the way across to today, to whatever today's price is. What is that? 50, 60,000-ish. Can't get it exactly on today. But this is the full 16-year history, 17 years if you go November to August, history of Bitcoin. And there's just one major thing I want to take away from here, is that when you zoom in on this, you can start seeing what I call the multiplier windows. They're these 3 to 5 year windows where huge multiplication of value happened. So let's look at the first window. Let's look at the 2009 to 2012 window. 2012, right. So 2009, Bitcoin being created and mined out. Nobody knows about it. And for 18 months, it has no value, no first pizza purchase, no one investing, no one buying, no value. And then it got to 6 cents, 7 cents. Eventually, a year later, it got to 17 cents. And then we keep going all the way to April 2011. And this is the first time we see what we call a hype spike. Suddenly, more people than before. So let's say that 10,000 people globally knew about Bitcoin. Suddenly that number jumped to 100,000 people knowing about Bitcoin. And there was this sudden hype and headline period, okay, where it was being spoken about on Reddit groups, it was being shared on Facebook, it was being shared in all these big groups and went from 10,000 people to 100,000 people. That's the example we're using. That created catalytic or hyperbolic growth. Sudden headlines, sudden hype. The problem with headlines and hype is that people can get caught in that trap. So anyone who is buying Bitcoin up here, they had a negative experience for the next 18 months. They went from $22, $23, $24, and their experience of Bitcoin was plummeting, 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 plummeting. And they're the ones who went down to $2 and went, Bitcoin's a scam, Bitcoin's failing, don't buy Bitcoin. I lost so much money in Bitcoin. Look at the difference though. The guys who were mining Bitcoin at 2 cents, 6 cents, 17 cents, 20 cents, their experience, well, 100x and 10x. That was their experience. They got in at ground level and their story was radically different. So these hype and headlines are not the stories we focus on. They're the stories most people focus on. We focus on infrastructure stories. The guys mining at 0 cents, 20 cents. They had a 10x and 100x, 2 cents to $2, 20 cents to $2, 100x, 10x. That's their story, their journey. And if we follow this through the whole 3-year window, it gets all the way up to $12. That's an exciting journey within a 3-year window. But if you zone it out a little further, if we take the zoom and we take it out to 5 years, so 2009 November to 2014 November, let's go here. The journey is, for the miners, a couple cents, 2 cents, 10 cents, 20 cents. Their journey is now at $300. Now, again, there's a whole group of people who came through Bitcoin, who bought it up here at $1,000 and $900 at, $919. They had a radically different experience. They lost money all the way down to $300. They told their friends, don't buy Bitcoin. It's a scam. It's crashed. The hype and headline journey is very different to the infrastructure journey. And in fact, there were some people who, after that, look at tiny this little spike is now. After that first spike we saw, that was $20. Some people started mining Bitcoin at $11, $12, $10. They're also having a big success story. Some people started mining Bitcoin at $100 and $90. They're also having a big success story. And if we move this window all the way across to another 5 years, so let's go to November 2014. So here we are, November 2014. Look at all these guys mining Bitcoin, $300, $200, $300, $200, $300, $200, $400, $300. So for the space of over 12 months, people are mining Bitcoin. It's doing not much. And then there's a sudden spike up to $17,000. This is the hype and headline story. Anyone who purchased cryptocurrency Bitcoin up here, their story was, I bought it at 17 and 15 and 14. It's now valued at 3. Don't buy Bitcoin. It's a scam. It's crashed. It's failed. Everyone involved at infrastructure level, mining it, creating it for a year, 2, 3, they've got a very different story. $200 to $3,000, $300 to $3,000, $700 to $3,000. That's a very different story. We slide the window again all the way to the next 5 years, so to 2019. 2019, wow, there we are here. 2019, mining at 10,000, 8,000, 6,000, 8,000, 6, 9, 10,000. Massive spike, 61,000, 65,000. There were a bunch of people buying Bitcoin over here. Their journey over the next 18 months was from 60,000 down to 17. Don't buy Bitcoin. It's a scam. It's crashed. The guys mining it, 7,000, 6,000, they're sitting at 17,000, 20,000. I want you to notice that as we've moved the window, the multiplier is not as big. Let's look at that again. Take note of this, please. As we move the window, the first 5 years, mining it at 6 cents, at 20 cents, the multiplier over 5 years from 20 cents to $300. In the Q&A, what's that multiplier? How many X's did that climb? Let me know in the Q&A box. Okay, write that down. Then compare it. Let's go to the next 5-year window. So 2014 November. Okay, now let's look what the multiplier is. $200, $300, $400 up to 3.5. Big multiplier. Is it as big as the people from the first 5 years? Just if we're comparing windows of time, 5 years to 5 years, which multiplier was larger, the first window or the second window? Okay, and you guys are doing the math. I'm not doing the math. You're doing it for yourself. Okay, and then let's look at the window again. Let's slide the scale. Okay, let's look at this period again. It's 2019, 10,000, 8,000, 7,000 to 13, 16, 20. Okay, there's a multiplier there. Is the third window bigger or smaller than the second window? So second window bigger or smaller than the first window, multiplier-wise? Let's check your answers in the Q&A. And again, this is a workshop because I want you to walk away empowered with knowledge. empowered with understanding, blueprint, and infrastructure and growth. So let's look in the Q&A. Which window had the largest growth? Okay, let's see. Okay, which window had the largest growth? Which window had the smallest growth? Window 1, 2009 to 2014. Window 2, 2014 to 2019. Window 3, 2019 to 2024. Which window had the largest growth? The largest multiplier. If you'd put $100 in one of those windows, what would that value be? Which bigger or smaller in window 1, window 2, window 3? Okay, the largest multiplier was window 1, the first 5 years. The second largest window multiplier was window 2. The third largest was window 3. What does that tell you over time? It tells you that as Bitcoin, which is a fixed supply coin, only 21 million, as more and more people started using it, it created big spikes in growth that then tempered over time. The multiplier became smaller as the community grew larger and larger and larger. That's the first thing to understand, is that on a fixed supply coin like Bitcoin, the tokenomics, okay, the economics that surround that cryptocurrency, that's what tokenomics mean. The economics have the largest multipliers in the early windows and smaller multipliers in later windows. How do we say that in layman's terms? It's better to get in early than in late. Okay, it's better to get in early than in late. That's a simple way to put it. And you can go and track the same data for yourself. You don't just have to do it with Bitcoin. You can go to another site that tracks Ethereum. So TradingView tracks a lot of different cryptocurrencies, but you can go and look at Ethereum's journey. And again, Ethereum launched, 2015, 2016. So quite a few years after Bitcoin. But we can see that the early adopters, the early mining community, you can't even mine Ethereum anymore. But the early mining community, they were the ones that had the largest multipliers of growth. Guys who are mining it at 6 cents, at $6, at $12, at $10, within 5 years, so 2021, sitting in the multiple hundreds of dollars. The guys who mine for the next 5 years, the window that we're in here, so multiple hundreds of dollars, it's now sitting in the early thousands on average, 1.5 to 2,000. Okay, we're looking at the average price is not the highest highs. So what does that tell you? The first 5 years had a larger multiplier than the next 5 years. That's just the one thing I want you to take away. The tokenomics, okay, based on supply and demand, show that early adoption with these types of projects is better than later adoption. Does that make later adoption bad? No, I don't think anyone who's buying Bitcoin today will complain in 3 to 4, 5 years time. I don't think people buying Ethereum today will complain in 3 to 4, 5 years time, because it shows us historically that when you got a fixed supply coin, it can grow over time. Does our money work like this? Let me know in the chat function. Does rands, dollars, pounds, euros work like this? Do they grow in value over time? Let me know. If your answer is yes, tell me why you say they grow in value over time. If your answer is no, tell me why the value doesn't grow over time. Give me a reason. I want to see if we understand this, because most of us are banking in dollars, pounds, euros, rands, etc. Why are they different? Okay, I love the answers I'm seeing over here. Okay, they lose value over time because of inflation. Okay, governments, Jerry's put it beautifully, governments print more money. Now, the most aggressive inflation that we've seen globally, I'm not talking about localized inflation like we've seen in places like Zimbabwe, Venezuela, Germany, straight after World War II, all of those. I'm talking about global inflation. The largest global inflation that we've faced as a species has been since COVID. So world economies get shut down, jobs get lost, economy grinds to a halt, debt accumulates. How did the government settle that debt? Well, if you go into the Q&A, give me your answers on how they settle that. Quite a few of you have put the answer already. They settle that debt by printing more money and pushing it into the economy, and now that money sits with you and I. That's called inflation. The exciting thing about cryptocurrency, the exciting thing about Bitcoin, Ethereum, and some of the newer coins that have come out is that they are built to behave, many of them, opposite to inflation. They're built to be deflationary. And that should really excite us. This inflation thing that we're dealing with right now, this money that we work with, dollars, pounds, euros, etc., this is a new problem. This is a 70-year-old problem. Before that, money was backed by gold. It's called the gold standard. And there was a set amount of gold that gave money a set amount of value. We're born into a system, an inflation system that we think is normal, but it's only a 70-year-old system. And what cryptocurrency and what Bitcoin and Ethereum and Apertum and some of these other coins we're going to look at, what they arrive with is supply and demand, fixed supply, finite supply, economics that the world used to operate in. This isn't something new. It's a new technology, but the economics of it are pre-dollar, pound, euro, like what we're seeing today. Does that make sense? Just yes or no? If you're starting to understand that fiat money, dollars, pounds, euros, that are open to inflation is new money. It's only 70 years old. It's new since the Bretton Woods Conference. Go and read about the Bretton Woods Conference when we came off the gold standard. And so we're dealing with a new problem, a 70-year-old problem. So what if we could fix it? What if we could start working with Bitcoin, working with Ethereum, working with Apertum, where the economics are actually based on not Bitcoin 16 years of proof, not Ethereum 10 years of proof, but on money systems that have thousands of years of proof. We're letting that sink in. Blockchain's exciting, 16 years old, but actually the economics around many of these coins are provably thousands of years old. And that should really, really excite us. Now, before we go in and have a look at how we can position ourselves in order to take advantage of this, I want to explain blockchain giving two simple analogies. Okay, analogy one is this. Blockchain is an open accounting book. That means you can see every transaction that happens on blockchain. I'll show you right now. Let's go have a look at Bitcoin. Okay, Bitcoin's been around since 2016. We can open up Bitcoin's accounting book. So it's called a Bitcoin Explorer. Here we are here. Here's an example of one. We can see that there's 959,000 blocks of Bitcoin. So think of a block as the page of an accounting book. Okay, hold on to the accounting analogy. There's 959,000 pages of the Bitcoin accounting book. And those pages show 1,402,915,000 transactions. And we can go in and look at every single transaction that's taking place inside of the Bitcoin blockchain. And we can go back historically and look at every single block, every transaction, every block, every transaction for the last 16 years. We can do the same for Ethereum. Ethereum is a blockchain. Everyone thinks about the coin. Everyone thinks about Bitcoin, Ethereum, the coin, Apertum, the coin. But it's the blockchain, the accounting system that gives that coin real value. So let's look at Ethereum's accounting book. Well, Ethereum has, let's just count here together. They have 25 million pages, 25 million blocks, and they have settled 3,624,000,000 transactions. And then we can start looking into transactions. View all transactions. And we can go back and look at every single transaction that's ever taken place. So the first analogy is that Blockchain is an accounting book. Now, let me ask you a question. If everyone can access this accounting book, why aren't more people using blockchain? Why aren't governments using blockchain? Imagine if you paid your tax and you could see the tax land into what's called the government wallet. We'll call it the treasury. I think that's the name everyone understands, the treasury wallet. And then from the treasury wallet, we can see 10% goes to, the Department of Land. 5% goes to military spend. I mean, we know that's not true. It's more than that. This percentage goes into the maintenance of roads. This percentage. Imagine if governments put everything on blockchain. Well, we could see it. So why wouldn't you use an open accounting book? Why don't banks use blockchain, an open accounting book? Why don't S&P 500 companies use blockchain and open source accounting book? Why don't you want that information available to the public? Every page, every block showing every transaction. And why was Bitcoin villainized for so long? Ethereum was villainized for so long. Blockchain projects are villainized by certain players, certain people, certain platforms, certain corporations. Transparency. Blockchain gives you an open source accounting book. It takes out the middleman, the auditor. It removes the need for quarterly reports. It removes the need for shareholder meetings. It removes the need for all of this stuff, all these smoke and mirrors and communication, I want to say skills. It removes the need because everyone can see the data for themselves, see the truth, see where the spending actually happens, see where the value is. So that's the first analogy. It's an open source accounting book. The second analogy is that it is a super highway that's rebuilding the internet. Have you heard of Web3? Type the number 3 in the Q&A box if you've heard people saying, yeah, it's Web3. Well, we're building this Web3 project. Wow, we've got this new thing that's happening in Web3. We keep hearing this word, but what does it mean? Well, the internet currently is a giant photocopy machine. It's a Web2. It creates multiple versions of itself. So if I post an image on Facebook, that image is stored on servers, so those are duplications of it. And then if you want to download it, you're downloading a duplicate of a duplicate of a duplicate. The internet's a giant photocopy machine. What blockchain does is that it takes the information and it locks it into one of those blocks, one of those pages in the accounting book. Now, anybody can access that page because it's an open source accounting book. Anybody can access that page and that information. So you don't have to create duplicates of it because everybody's looking at the same thing at the same time. So when we talk about Web3, I want you to imagine the internet as being highways, all connected, sending information and payments and transactions and intellectual property and art and music and movies, all moving on the internet. And blockchain is the super highway that allows that to be very, very efficient. Now, you can have different blockchains or different highways. Bitcoin is one type of blockchain, one type of highway. Ethereum is one type of blockchain, one type of highway. Apertum is one type of blockchain, one type of highway. And just like building highways, as technology gets better, we learn how to build better and better highways. Think about the Roman Empire. Roads existed before them. They just happened to work out how to build them efficiently, quickly, and their whole empire expanded. And suddenly they could move produce, goods, services, armies, gold, silver at a rapid paces all over the known world. Well, that's what blockchain's doing. So when you think about blockchain, think about super highways on the internet. Two analogies: open source accounting book, super highway on the internet. And the more traffic, the more highway, the more value that moves along that road, that highway, the more valuable the coin that shares its name with the highway. Bitcoin is more valuable because more and more people use the Bitcoin highway. Ethereum coin is more valuable because more and more people use the Ethereum highway. we're going to be looking at a coin today, Apertum, that is going to become more and more valuable as more and more people use that highway. We missed the first 5 years of Bitcoin, 10, 15, we're now into year 16, 17. We missed the first 5, 10 years of Ethereum. What if we could grab hold of a coin today, Apertum, I'm going to show you, it's inside of its first 19 months, and we start building out on this new highway, new coin. We get a second do-over if we missed mining Bitcoin, Ethereum, etc. That's what we're going to look at today. So I want to take you across, and we're going to look at Apertum together briefly, and we're going to look at the health of the infrastructure. So where do we go to look at the health of any blockchain? We go into the Explorer. Now, you would have noticed with the Bitcoin Explorer, it was fairly basic because it's an old blockchain. The amount of information we're sharing was not very complicated. It was a little bit like the dirt roads before the Roman Empire arrived and started building real roads. Then Ethereum came along, built out a faster moving highway, more of the Roman type highway, blocks being laid, different uses for that road, moving armies, moving products, moving services. Ethereum really changed how blockchain worked, started being used for internet infrastructure. And now we're sitting 16, 17 years after Bitcoin. We're sitting 10 years after Ethereum, and the way to build roads, blockchains has improved. And we're looking at one over here. So here's Apertum. Apertum is what we call a layer 1 highway. It's 19 months old. It's taken the best of Bitcoin. It's taken the best of Ethereum, and it's married it into one type of blockchain. How many blocks, how many pages in the accounting book has it already created? It's created 12 million pages in its first 19 months. How many transactions have happened inside of this accounting book? There's already been 16 million transactions just in its first 19 months. And it's averaging over 26,000 transactions daily. But it's more than just what Bitcoin is. And it's becoming more than what Ethereum is, because it gives people the ability to build different projects onto the highway. Think about it like this. If you're traveling along a highway and you need gas, you pull over. Now, who owns the gas station? Same company that owns the road? No, it'll be Mobil or Shell or ADNOC or one of these independent companies. So suddenly you leave the road and you arrive inside of the gas station. You put gas in. That gas station maybe has some subtenants in it. Maybe a little coffee shop selling coffee, another shop selling energy juices and some snacks. One highway, 3 companies that you're interacting with. And what Apertum has done is it's created the accounting book, but it's created a highway, and it's given people tools to be able to build different uses, to be able to exchange value, to be able to bridge from one highway to another, move from Bitcoin to Ethereum to Apertum. It's building out ways for people to manage NFTs, non-fungible tokens. We'll talk about that another day. It's building multiple different uses. And because of that, there's different companies, different projects, different cryptocurrencies being built on Apertum. So you can scroll through here and you can see there's lots of different types of tokens, types of uses. Think about these as vehicles traveling along a highway. Every time you see a name change, that's a type of vehicle. And this is how many people own that vehicle. So you got this thing called a DID. 55,000 people own these DIDs that are moving along this blockchain. You got wrapped USDT. Okay, that's a token that's 1-for-1 to the US dollar. 25,000 people own amounts of that are moving along this blockchain. And so you got all these different types of cars, vehicles moving up and down this blockchain. And these are all owned by different people moving up and down, up and down, up and down. When we look at blockchain, when we look at cryptocurrencies, we need to understand we're not looking at a coin and a price. We're looking at what's below that. What's the infrastructure? What's the value proposition? What is its use? What problems does it solve? What opportunities does it give? How many people are using it? How many transactions have been settled on it? How many blocks have been placed in the road? 10 out of 10, 10 being, this is all making sense. I'm so glad I'm on here. 1 being, I have no idea what this guy is saying. Just rate what your understanding is so far. And after you've rated that understanding, ask 1 question. Not every person on here, you don't have to, but ask 1 question that you would really love the answer to based on what we've covered so far. Okay, because we've just covered basic stuff. We've covered what is blockchain. There's 2 analogies to understand it. What was Bitcoin's growth over 5, 10, 15 years? What was Ethereum's over 5, 10? What are transactions? What are blocks? What are, what we've just looked at now, tokens? Figure out a question that you really want answered. Let me quickly scan through and I'll see if I can answer. We're getting lots of 10 out of 10s, which is great to see. We're getting some 3s. Well, welcome to the call. Great to have you here. Yeah, 3, 3, 3, and then 10s, 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 some 9s, some 8s. That's good to see. Let me pop into the question area. Jerry's saying, will we be able to mine Apertum? So Jerry, I'm going to be talking about mining in a moment. Let's ask questions specific to what we've covered so far. Judy's saying, how many companies presently are using this blockchain? So Judy, if you go look at the Apertum Explorer that we were on, go look at all the different tokens. Every token represents different projects, different uses, different companies building on it. Bronwyn says, how many accounts in total are currently using Apertum blockchain? It's over 500,000. And again, you can look at that on the Explorer for yourself. So let me just open that up for you. Let's go back to the just the landing page here, because a little summary. So total addresses, it's the number of wallets that connect and interact. It's over 500,000, 500,000 plus addresses, 19 months old. So still very, very early days. And what do we know from Bitcoin, Ethereum, etc.? It's quite exciting to look at something in its first 5 years. Okay, there's a question coming through here that says, how is Apertum predicted to compare to Bitcoin and Ethereum? So this is a great question from anonymous attendee. So to answer your question, anonymous, there's certain similarities between Bitcoin and Apertum, and there's certain similarities between Ethereum and Apertum. So let me first unpack the similarities on the Bitcoin side. Bitcoin has what's called a fixed supply. That means there's only 21 million Bitcoin. There can never be more than that. Apertum, there's 2.1 billion. It's also a fixed supply. There can never be more than that. The code doesn't allow there to be 21 million and 1 Bitcoin. The code for Apertum doesn't allow there to be 2.1 billion and 1 Apertum. So that's the first thing. They're fixed supply coins. The second similarity is that they can both be produced through something called mining. Mining is when a block is created on blockchain, and any miner involved in that activity gets a share of the coin. So with Bitcoin, in its first 4 years, anyone who is involved in creating a block, they got a share of 50 Bitcoin split amongst those miners. It then went through something called a halving protocol, where the next 4-year period, the number of Bitcoins released every block was only 25, and that was shared amongst the miners. Apertum follows a similar emissions model. So every time a block is created, 8 Apertum are released and shared amongst the miners. It'll run like that until it hits the 125 million blocks, and it'll halve, and only 4 Apertum will be released. So they both have fixed supply. They both have fixed emissions with a halving protocol. And then the area where they differ slightly is that Apertum has something called a burn mechanism, meaning that every transaction that happens on the Apertum chain, a small amount of Apertum are burnt. It's called a transaction fee, and those are put into what's called a burn wallet, a wallet that can never be accessed. It's the same as that being thrown away. And what that means is, as Apertum are being used, their supply is being decreased incrementally over time. So that's where they differ slightly. Now, when we look at Apertum Ethereum, there's similarities again. And the biggest similarity is that they can both be used to build other projects. You look at Ethereum, Ethereum is used as a highway, but there are multiple projects built alongside that highway, multiple different tokens, what we would call different cars that are using that highway. So there might be a project involved in real estate, and they've created their own little cryptocurrency called real estate coin. Their cryptocurrency is using the Ethereum highway. There might be another project that's built an exchange, another project that's raising funds for wildlife. All these different projects that have been built over the last 10 years using the Ethereum highway. Apertum does the same thing. So it has the same ability for projects to use their highway, but to build their own projects, have their own cryptocurrency, their own tokens. We call that smart contract capability. So they share those similarities. Where they differ is speed. So Apertum is a lot faster than Ethereum. How do we know that? Well, we can go look at the average amount of transactions that Ethereum can open and close per block. And we can look at Apertum's. You can see that Apertum is over 1,000x faster. So what does that mean in 5 years' time, in 10 years' time? Well, it's able to process more traffic. So imagine Ethereum can only ever get to 6 lanes in the highway, and then it can't build further than that. That's its maximum capacity. Apertum can go 60 lanes, 600 lanes, 6,000 lanes. Because remember, newer technology, taken all the learnings from Ethereum, all the learnings from Bitcoin, all the learnings from other projects, Solana, Avalanche, Polygon, all these different other projects, and gone, how do we make a next generation blockchain? So I hope that answers your question. It's comparison on what has worked and what can be made slightly better. Lawrence asked the question, and then we're going to move on. Do all crypto coins grow in a similar pattern to Bitcoin? No, Lawrence. Generally, fixed supply coins do, okay, because they're anti-inflationary. And then again, if you look at the similarities on emission, so how they come to the market, supply and demand, fixed supply, all of that, then they might behave similarly. I hope that answers your question. Right, so phase 1 done. We've spoken about blockchain, we've spoken about analogies, we've spoken about Bitcoin, Ethereum, their history, their blueprint, we've spoken about Apertum, transparency, its capability, its similarities and differences with Bitcoin and Ethereum as well. Now we're going to talk about how you can accumulate cryptocurrency. And there's 4 different ways. I'm going to share my screen with you and we're going to go through this together. So let me just share my screen on my iPad. Give me a second here. But there are 4 ways to accumulate cryptocurrencies, 4 main ways. And let me just show them to you right now. Okay, so here they are here. Anytime someone is talking about accumulating cryptocurrency, they're doing it through 4 different methods. Method 1 is that they are buying, holding, selling. We call this trading. That's the first way that you can get involved in cryptocurrency. Trading is either buying and holding, or it's selling, buying and selling. And so some people buy Bitcoin and sell it years later. Some people buy Bitcoin and sell it seconds later, buying and selling, trading. That's one way. The second way is through mining. Mining, as I explained, it's only possible with blockchains that have mining protocol. So in other words, blockchains that every time a block is created, they spit out X amount of coins, okay? Whatever that coin value is, whether it's Bitcoin, Zcash, Apertum. And then when the next block is created, they spit out a certain amount of coins. And the next block is created and they spit out X amount of coins. Picture it like this. If you were building a road, every single day, guys would arrive with hard hats, dressed in blue overalls, bright orange jackets, and they'd be creating the road, laying the road. And for that work, they would be paid. Same thing. Mining is the creation of each block, and every time you create a block, you can earn some of that coin. Now, the interesting thing is, people who are buying and selling, so people who are trading cryptocurrency, if they want to buy and sell Bitcoin, well, Bitcoin can only get to the market from the miners, so it can only go in this direction. People who want to buy and sell Apertum, well, they can only get it from the miners. So a good way to think of this is the source. These guys control supply and demand. They created first. You might mine this coin in the year 2026, but you might only choose to sell that coin in the year 2031. I'm going to say that again. You might mine the coin when it's sitting at 10 cents, but you might only sell the coin when it's sitting at $10. Mining is exciting because you're the source. Right, another way to accumulate cryptocurrency is through something called staking. Staking is offered by central exchanges only, okay, because these are licensed products. Staking is when you lock cryptocurrency for a certain amount of time, and because you lock that cryptocurrency, you earn interest on it. Central exchanges that offer staking need to be licensed. Okay, why? Because this sounds very similar to how banks work. A bank essentially says to you, come and give your money to us, lock it up in a savings account, in a fixed deposit account, in a whatever account, and we will pay you interest on it. Because the bank takes it into custody, okay, they take security of it. They need to have a securities license. We are going to take custody, and because we're taking custody, we're going to pay you a fee. How is that possible? Because whatever you've locked up is now being loaned or shared somewhere else. And that loan or that share is also being charged a percentage, and you're getting a split of that percentage. That's how staking works. Okay, it's a financial product. Staking is offered by central exchanges only because central exchanges have to be licensed. Then the fourth way, this is the last way I'm going to talk about tonight, is something called liquidity providing. Now, this is only possible on decentral exchanges. I'm going to talk a bit about that today. Decentral exchanges, these can only be built on smart contract highways. So again, highways like Ethereum can have decentral exchanges. Highways like Apertum can have decentral exchanges. And these exchanges interact with people's wallets directly. So they don't take ownership, they don't take custody, they don't take security of anybody's cryptocurrency, and they don't lend it out to somebody else. So no license is required for a DEX. And the way that that works is a DEX, a decentral exchange, allows someone to sell, let's say they want to sell USDT in order to buy Apertum. When they do that, the person who has provided both USDT and Apertum into what's called a liquidity pool, they earn the trade fee when someone buys or sells, all happening through smart contracts. We might get stuck on this point, but here's the idea. If you provide apples and pears to the fruit market and someone else arrives with more pears and they want some of your apples, you're happy to take more pears. They can take some of your apples because you've just earned a bit of a fee. You've earned 0.3% more pears. Okay, this percentage can start adding up. Decentral exchanges offer anything from 10 all the way up to, I mean, as high as 50% per annum. And it's without them ever taking custody. So that's really exciting as well. I like these because I don't have to give custody over to someone else. Okay, generally, if I'm trading, I have to trade either through a broker or I have to trade through a central exchange. And if I'm staking, I have to use a central exchange. That means I'm giving my cryptocurrency, I'm passing its custody, its security to someone else. Whereas on this side, with mining and with decentralized exchanges, everything that is mine stays in my custody. I don't know about you, but I've probably lost a lot of trust in centralized systems in the last few years. I've seen good centralized systems come under big pressure from regulators who, want to impose some form of fee on top of it, some way to make money. I've seen centralized entities be mismanaged. I've seen centralized entities break laws and get shut down. I've seen centralized entities have the shareholders' best interests at heart and not the token holders. And so I'm quite excited about anything that keeps custody, keeps control with me. And again, right at the beginning of this call, I said I'm going to be sharing my opinions. I'm going to be sharing my views, and I'm going to always encourage you to go and do your own research. And so tonight, we're going to look at Apertum DAO mining. So how to mine your own cryptocurrency from your own wallet, self-custody. We're going to look at mining, so that's self-custody. And we're going to look at decentralized exchanges, self-custody. I'm not going to talk about central exchanges. I'm not going to talk about trading. I'm not going to talk about staking, because those are centralized activities. And you should be speaking to either brokers or financial advisors or licensed individuals if you're going to be doing activity on centralized licensed systems. Are we okay with that? Just say yes if we are. It's a blockchain workshop. There's lots to blockchain, but I want to be very clear that with the changes that are happening globally from regulators, the more centralized something is, when you are handing custody over to someone else, in other words, you're giving them management of your cryptocurrency, either in a trading brokerage, in a central exchange, in a staking, anytime you're doing that, you are handing fiduciary duty and legal duty over to someone else. And so I'm going to stay away from that space because I don't want to give advice on that. That is something that someone who's licensed probably should. We're going to spend time on mining only, self-custody, decentralized mining, and we're going to spend time on the DEX only tonight. So let's head across to that together. Let's first start on mining. Okay, just before we do, any questions on those 4 ways to accumulate cryptocurrency? We've got trading, staking, mining, liquidity providing. Any questions on that before we go look at it together? Because we might have some questions coming through on that. Let me check. Questions. Okay, so anytime, there's a good question here. So anytime there's any staking is offered by central exchanges. So if you've got staking in BitX Live, if you've got staking with Binance, if you've got staking with Coinbase, if you've got staking with Nexo, any of these central exchanges, those exchanges, obviously, like any central exchange, they're licensed in certain jurisdictions. That's why they're able to provide staking. And again, I'm not going to get into that tonight because those are centralized entities. Rob McKenzie's asking, can I put the picture up again? Rob, yeah, I'll throw it up now. Give me a second. You guys can take a little screenshot of it if you want. It's a little bit messy. Don't know if it's my best work. But let's chuck it up there very quickly. So screen, start broadcast. Hold on a second. Coming through now. Up. And here we go. So, and I've separated them left and right. I've tried to explain that one side is more let's put it like this. It's divided like this, and say that these are your centralized activities. And I would say that these are your decentralized activities. Another way to explain that is these are managed activities. In other words, you are putting your cryptocurrency, you're exposing your cryptocurrency into someone else's platform. It's sitting under their management, their ownership, their security, their protocols. Whereas on this side, I would say this is called self-custody. So in other words, you need to have your own wallet set up and you're only interacting through smart contracts. Okay, those are the two major differences. So on decentralized, all the responsibility sits with you. So it is, I call this adulting 101. Okay, because you are the final say in everything. And in centralized and in managed, that's more like parenting 101. I'd call it that, because you are trusting someone else to make the decisions on your behalf. And you trusting that the management team and the legal team and the compliance team and all of this is doing all the right things with your assets, your cryptocurrency inside of their control. Okay, you can screenshot that and then we can move on to, we're going to do this. We're going to have a look at Apertum mining specifically, and we're going to have a look at the Apertum DEX specifically tonight. Okay, so that'll be our next section together. So stop share. And let's go have a look at it together. Let's start on Apertum. And I'm going to come across into, so there are two ways to interact with Apertum mining. You can either do it through the Apertum DAO platform or through the mining manager platform. I'm going to go to the Apertum DAO platform. This is terms of service that I got back on. So let's get out of here. Hold on a second. I've just got to attach. Let me just connect my wallet to this and then I'll share my screen. Give me a second here. Sorry, just jumping through some little infrastructure here. And then I'll share with you. Okay, my wallet, connect. Okay, let me get into screen share mode. Where are all of you? Here you are. Screen share, screen share, screen share. Okay, so let's have a look at the Apertum DAO miners. Now, these are NFTs. That means that you purchase it, it goes directly into your own wallet. Now, I'm going to show you the wallet that I prefer to use. I like to use the MetaMask wallet, okay, because I can hold my cryptocurrencies in here. I can click on tokens. I can manage my tokens. So I can choose which cryptocurrencies I want to host inside of this wallet. And there are literally hundreds and thousands of different tokens built on different blockchains, so built on different superhighways. I can also host NFTs inside of here. So you can see that the miners that I purchase sit inside of my wallet. Okay, they don't belong to someone else. They're not managed on someone else's platform, etc. So I like this wallet. However, having said that, I do know there's a large community who use MetaMask. So MetaMask is also a self-custody wallet. And the same thing again, it can hold lots of different cryptocurrencies. It can interact with lots of different blockchains. And you can also keep your NFTs, the miners that you purchase inside your own wallet. So you choose whichever one you prefer. I really, really like Zova. And when we talk about a self-custody wallet, let me just explain this a bit better. When you set up a self-custody wallet, you can set them up on your phone or on your laptop. I like setting up on my phone first because my phone allows me to use the browser that's built in to the wallet. So MetaMask has a built-in browser. Zova has a built-in browser. And the reason why I like to do that is, have you noticed that your browsers have been doing updates? Like, put in the Q&A box, how often do you have to go to the top left corner of your laptop browser and click update? Is it once a week? Is it once every 2 weeks? Is it once a month? Let me know in the Q&A box. I'd love to know how many times you guys are having to update. I use different browsers on my laptop. I've got Safari set up, I've got Chrome set up, and I've got Brave set up. And I'm averaging once a week on updating my laptop browser. And whilst that doesn't sound like a bad thing, when it comes to blockchain and interacting with different platforms, every time you do an update on your browser, you've got bug fixes, you've got settings that change, you've got new security protocols. There was a time when there wasn't biometric. Now there is biometric. We've got a time where there was cookies in place, pop-ups in place, blockers in place, trackers in place. All of these updates add in all this extra functionality. And I hate that when I'm trying to set up a wallet and interact with a platform like Apertum DAO, because I've got all these different security settings blocking some of the actions I'm trying to take. So I want to suggest to you, if you're setting up self-custody wallets, MetaMask, Zova, first set it up on your phone, go into your app store. So Zova is spelled Xova, MetaMask is spelled Metamask. You can search for them on your app store, but you can download them. And then what you've got is you've got a wallet, and inside that wallet, you've got a built-in browser. So anytime I'm copy pasting, a DEX address, every time I'm copy pasting my miner manager address, I'm putting it straight into my wallet browser, and I can work very, very quickly. It's only afterwards that I've now also downloaded the wallet extension into my browser. But even that, every time there's a browser update, I've got to go and see if there's any extension updates I've got to do, etc. So yeah, if you want it to go easy, start on your phone. The second thing I want to say before we look at this, when you download your own self-custody wallet, it's going to ask you to write down 12 words. If you weren't listening, start listening now. When you set up your own self-custody wallet, one of the steps is to write down 12 words. The 12 words that you're given are the keys to your wallet. If you take a screenshot, I'll just take a screenshot so I can save it. If you take a screenshot, if you take a photo, if you save it to a folder, if you send the message to your wife or your husband or your partner, if you do anything with those words on your device, photo them or save them, it immediately goes onto a server, and server data gets scraped, and immediately some hacker out there has your wallet keys. Often people say to me, I thought I knew cryptocurrency. I've got a central exchange. I've been trading on Binance, and then I did the self-custody thing, and now my wallet's been hacked. Every single time, it's because they've taken a screenshot or they've sent the words to someone else. Remember right at the beginning, I said internet is a giant printing machine. It duplicates information, and it saves that information in multiple places. Well, that's like leaving your credit card details on a photocopy machine in a bus station, and it just keeps churning out paper, and anyone walking past can grab your credit card details, and then you wonder why your credit card gets hacked. Okay, do not take any screenshots, send it to anybody. You write it down on a piece of paper, and you put that piece of paper somewhere very, very safe. Okay, type 12 words if you've clearly heard me on that. It is the most adult thing you're ever going to do in cryptocurrency. It's going to take a lot of self-control because it's too easy to screenshot. It's too easy to send to a friend or someone you trust. Don't do it. Okay, so anyway, let's go and have a look. I've got my wallet set up, and we're going to have a look at the Apertum DAO mining bot. Now, we're going to go into the store. And the reason why I've got my wallet set up is anytime I do any purchases or any action, it's doing it through something called a smart contract. So in other words, I'm not depositing money onto a platform and then buying something. I'm actually making a purchase directly through the blockchain. And so the money stays in my wallet. And once I purchase something, the product arrives in my wallet. So I keep custody of it. Now, let's look at these miner bots. There's 6 different price points here, starting at $300, going to 1,000, 2,500, 6,000, 9,000, 19,000. Okay, these are just the different price points. I've been buying up $300 bots. Okay, I've got a dollar cost average mentality to this. and I just buy these up every 2 to 3 weeks. So you can see that I've currently got, I think it's 3, 1, 2, 3. I'm due to buy another one this week actually. So I'm due to buy another one shortly. What do these bots actually do? Well, these bots participate creating blocks and receiving Apertum. Now remember, there's only 8 Apertum released every block. Just like Bitcoin used to only release 50 Bitcoin, and then eventually they only released 25 Bitcoin every block. Then they released 12.5 Bitcoin. We're now sitting in a period where they only release 6.25 Bitcoin. Okay, Apertum releases 8 Apertum every single block. Now, if I buy a $300 bot, my $300 bot is going to go stand at the block. It's going to help create a block, and it's going to create the next one, and it's going to receive its little portion of Apertum. It's going to receive its little share of those 8 coins that are released. When I buy this bot, the only thing that I can fix at the moment I purchase, the only thing that is like stamped, is the number of blocks it'll mine. When I buy a miner, it's going to lock in that it's going to mine 25 million blocks. It cannot lock in the price of the coin because that's going to change. So forget about that. So this is like, let's mine for the next 2, 3, 4 years. Forget about the price. We need time for the superhighway to get bigger and bigger and used by more people, because then its value can grow over time. And the other thing, it's not going to lock the exact number of Apertum. Because remember, more miners mean the Apertum is being split amongst more people at each block. So it cannot lock the price, and it cannot lock the amount. It can only lock the number of blocks my miner is going to mine. So the higher the value bot that I'm buying, the more blocks I'm locking my miner to mine. The higher the value the miner, the more blocks I'm locking to mine. And based on the number of blocks that I'm locking, on current market conditions, so current value of the coin, on current number of miners, I could potentially end up with this dollar value if the market stays the same. We know, I'm going to say this again, we know for a fact the market won't stay the same. The chances of the coin staying at 14 cents forever is not possible. The chance of there being the exact number of miners every single day is not possible. The only thing we can lock is the amount of blocks. Now, if the value of the coin is lower, so let's say I purchase this miner today, I spend $300. On today's conditions, I'm going to get 25 million blocks. If I tell my friend Dave about this in 2 days' time, and the value of the coin is higher, then when he buys his $300 bot, it's going to dynamically create a different number of blocks for him based on the value of the miner and how many miners are mining. And when he purchases it, he will lock in however many blocks that is. So even though we're both spending $300, the estimator is estimating it in real time, dynamically, based on dynamic market conditions, and then it's locking the number of coins. That's why we always say over here, estimations are for illustrative purposes only, based on current market prices. It doesn't guarantee future performance. Estimator shows only the current potential. This can change based on an increasing number of miners and market conditions. Okay, we don't know. Will it be 14 cents? Will it be 40 cents? Will it be 4 cents? Will it be $4? We don't know. But whatever the value, we know that our miner is pitching up every day for 25 million blocks. That's pretty exciting. Just like when I was mining Bitcoin, had my processor sitting in a warehouse, and every day was at the blocks receiving its portion of Bitcoin. The mistake I made is I spent the Bitcoin as I earned it. I didn't understand that what if Bitcoin had more traffic on its highway? What if there were more people using it? I didn't understand supply and demand. I understand it now with Apertum. That's why I said at the beginning of the call, now we've got a do-over. If you typed in, I heard about Bitcoin in 2010 and did nothing, 2026, you've got a do-over. If you typed, I heard about Bitcoin in 2016, I didn't do anything with that, you've got a do-over now. If you typed, I used to have Bitcoin and I sold it, you have a do-over now. And the difference is you now understand infrastructure growth. What does Apertum look like in 2 years' time, in 3 years' time, in 4 years' time? So that's the miner. The exciting thing about that is it's not a processor sitting inside of a warehouse. It's not a data center eating up electricity and water. It is an NFT. It's a coded contract that sits in your wallet, and it participates with every block that gets created. Any questions on mining? Because people really try and make this confusing. But if you understand that you're creating a highway one block at a time, and your miner is a little blue-collar digital laborer that's arriving and helping, and it's getting its portion of Apertum, then you understand that, hey, you're here to build infrastructure. Your miner is receiving the coin in 2026, but you can decide to sell it in 2031 to the markets. You might be mining the coin in 2026, but you can decide to sell it if it gets to $1 or $2 or $5 or $10. Just like the Bitcoin miners. We're seeing guys who are selling Bitcoin today that mined it back in 2016, 2010. Those were the smart miners. And that's what's really exciting for me. I love mining. I love the fact that we're sitting in a place where the technology has moved past data centers. It's moved past electricity, water, resource. You know, I don't know if you guys have been tracking with AI, but you know, AI and old blockchains are in competition for processing power right now. True or false? You know, who's got the bigger budget? Because those old blockchains, they're in competition with data centers, and the data centers are in direct competition with you for your water and your electricity. I'm glad I've got Apertum. It's a blockchain that's not in competition with me for my water or my electricity. I'm excited about that. We're going to look at the DEX in a moment. So let's answer some questions here. Debbie's asking, if the price goes up, how does it affect the number of blocks? Does it decrease? Debbie, that's a great question. So again, let's use the $300 example. If I buy a $300 bot today at 14 cents, it's going to look at current market conditions, and then it's going to calculate how many blocks I need to mine for me to be in a position where my $300 might be worth $600 or something like this. If you are buying your $300 bot and the value of the coin is 40 cents, it's now taking that market condition and it's trying to work out how many blocks you would need to mine based on current market conditions to get to about $600 of value. So you'll need less amounts of blocks potentially. And the same is true the other way around, which is quite exciting. You know, some people panic. What if the coin goes from 14 cents down to 10 cents? Great. You just end up with way more blocks than the person who got their miner at 14 cents. So it's almost like it's self-balancing itself before it then creates your bot, delivers it to your wallet. NFT stands for non-fungible token. Non-fungible means not the same. Every one of us, our miners, it might be called an MB1, might be called an MB2, it might be called an MB3, but every NFT that we purchase is slightly different to the next person's and the next person's and the next person's. Not the same, non-fungible token. So yeah, great question, Debbie. Thanks for asking that. Nicola's asking, so when you buy a bot, do you just leave it to mine or do you have to do something to assist it? Nicola, you can buy the bot and leave it. It runs on code. You know, it's not there waiting for you to do anything. I would encourage people to go and claim the Apertum that it mines. So let me show you what that means. Claiming is a signal that you send to the blockchain to say, hey, my miner, my blue collar laborer has been putting down blocks and the blockchain owes it X amount of coins. That's called a claim. It's a claim on service. It's a claim on productivity. And so you don't lose the claim, by the way. It just keeps tracking the blockchain. Remember, the blockchain is an open source accounting book, so it looks at every single transaction. So it just accumulates. You can see I've got 101 Apertum sitting here, sitting in the blockchain. So my bots have been standing there helping. And now I've got these to claim. So I can say claim all. It says this is how blockchains work. It gives me a bit of a rundown. I say start claiming. And I don't know if you can see my screen right now. So let me stop share and start share again, because you're going to miss what my wallet's showing. Here you go. It's opened a separate screen. So let me show you that. So actually, it now sends a signal to the wallet. Hey, do you want to start this transaction? All done on smart code. Let me move this menu bar out the way. So I'm going to say sign, confirm, transaction created. And now I've lost all of you. There you go, sign, confirm. Another transaction created. I don't know if you can see my screen anymore because I seem to have lost all of you. And it's asking me to confirm one more transaction. Because remember, I've got 3 miners standing at the blockchain helping do their part. So I'm literally doing 1, 2, 3 different miners, 3 different claims. I don't know if you guys can see any of this because I've lost all of you now. Just let me know if you can see. I can't see your screen now. Okay, so it flipped out the moment I did a claim. I think it's just a security setting. But let me share it again and maybe we can see. Yeah, so okay, so here it's giving me a summary of what I've just done. I went and claimed it 3 times on my wallet. It's told me this is what you've claimed. And you can now see number of coins has dropped down from 110 to claim. Now there's only 73. So what it does is it goes, well, it's going to pay out until that block there. And then it's going to ask for the next instruction. So I'm going to go through the process again. I'm going to claim all. And I'm going to claim like another 40 coins at a time. So it runs it out all the way until it's at 0. And I've claimed all my coins. So to answer your question, that's probably the most work you have to do is every now and again, go in and claim whatever you have mined. You're not going to lose it if you don't claim it because it's timestamped, but it does sit there and it does wait for you. I'm going to touch on one more thing specific to the miner, and then I do want to talk a bit about the DEX because that is an absolute hero and people are not paying attention to it. So let's head across there in a moment. Share screen, get into the miner. So Apertum DAO sells miners, which is fantastic. So this is kind of your store. You can register with Apertum DAO. Whoever has invited you onto here, they'll be part of the marketing team, or we call the referral program, and they'll be able to send you a link. They earn a commission every time you purchase a product. That's our whole marketing strategy. We're not going to go spend a bunch of money on corporates and corporate marketing agencies. We'd much rather spend it on the community. So there's a referral program in place. You can get a referral link. Any products you buy, there's a commission. And you can do the same thing. You can also get a referral link. So here's an example of it. Very, very neat, very tidy. Send it to someone, help them set up. And if they purchase a miner, you get a commission for that. But the miners currently are inside of a promotion period. So if you're watching this in August, you're sitting inside of a promotion period where for every 3 miners, basically, you buy, you get 99% off. So here's the promo guide. You can download it. I'm giving you the very summarized version, by the way. You can get the full version sent to you. But every single time you buy a miner, currently during this promo, let me get onto the next screen here. So you can accumulate discounts. If you buy 1 miner, you've already got a 35% discount that you can apply on your next purchase. If you choose not to use it, and you buy a second miner, you now accumulate a 70% discount on your next purchase. If you choose not to use it and you buy a third miner, you then get a 99% discount on your next purchase. So you can increase the discount based on how many miners you purchase. If you're only buying 1, then you've already got a 35% discount on your second purchase. Amazing. If you're buying 3, so if you spend $900 on the $300 one, you've now got 3 miners. You can spend $3 to buy your 4th one. That's what 99% off looks like. So this is a great promotion if you are looking to stock up on miners. Some guys ask me, which is better to buy the $1,000 MB2 miner or 3 300s. I think different strokes for different folks. If you're spending $900 and you're getting 99% off on your 4th purchase, you're essentially ending up with $1,200 worth of mining versus spending that $1,000. So maybe there's something in that. You go do the math for yourself. Promotion's fantastic. Go have a look at it. Go ask for the download document so you can read through the terms, the conditions, how exactly it works. But that on its own is a fantastic, simple product. Buy an NFT, keep it in your wallet, mine for the next 2-3 years. Don't treat it like an ATM. Don't make that mistake. This is a do-over. This is a second chance. Apply a better strategy. If you really want to make cash flow, I would say use the marketing plan. Download the referral program. There's 3 types of commissions. There's a direct commission, which is lucrative, 15%. So if you sell $1,000 miner, you get $150. You sell 10 of those in a month, that's $1,500 extra dollars. The second type of commission is what I call micro commissions, and those pay up to 9 levels. So think about the circle of influence you have, the people you directly connected to. They will know people. That's called the second circle of influence. It's like a ripple effect. They will know people. That's your third circle of influence. They will know people. That's your fourth circle of influence. So the ripples expand outwards to 9 ripples, 9 circles of influence, and you can earn 1% on sales that are being made by people you don't even know. So those are the micro commissions. That's fantastic. And then the third type of commission are bonus commissions. And those come down to, volume and sales. We've got some people who have Instagram channels, some people have YouTube channels, some people who run on TikTok, on Snapchat, whatever. They're connected to 100 people or 1,000 people or 10,000. Some people have over 100,000 people that follow them. And you can share a little video. Hey, I'm on Apertum. I'm excited about this coin for X, Y, and Z. Would love to get on a call and show some of you. DM me crypto if you want to find out more. And whoever DMs you crypto, you can reach out to and show them your miner and show them how it works, and you can make sales like that. So I love the referral program. I think it's a smart way to get our own community earning whilst obviously growing the community. So that's great. Now, I did say I wanted to talk about a hero that no one's paying attention to. And that hero is this decentral exchange. So let me pop across to a decentral exchange. Let me see if I can find, where's the DEX? Here we are. So this is a decentral exchange. This exchange interacts with whichever wallet it's connected to. And you can swap cryptocurrencies on here. So if you've got Apertum coins that you've been mining, and maybe you want to flip it into, some USDT, then you can say, oh, well, I've got 600 coins and now I'm going to get almost $100 worth of USDT. That's if you wanted to sell your coins today. Again, that's not my strategy. I'm going to wait for the coin to grow in value. I'm going to, sell the coin at a later state. But anytime someone is buying or selling, they're buying or selling through something called a liquidity pool. A liquidity pool just means something that has 2 cryptocurrencies inside of it. So if we go look at pools, the best way to look at this is to choose one cryptocurrency. So let's choose the main one within the Apertum chain. Let's choose Apertum. And we can now see all the different pools, the different pairs that exist with Apertum. These are the pairs that you can buy and sell into, not through a central exchange, not through an order book, not, where you are handing over management to someone else. You can do it directly over here. Let me just see if I can load this a bit quicker. It's a little bit slow today. Whilst we're waiting for that to load. Yeah, we're in the right wallet. So let's have a look here. Apertum, right. So let's look. So you've got Apertum pairing with USDT. You've got Apertum paired with Bitcoin. You've got Ethereum paired with Apertum. You've got Apertum paired with Binance. These are all the different liquidity pairs. Always 2 coins sitting inside one pool. So Apertum USDT, that's one pool. Apertum Bitcoin, one pool. And you can actually add to that pool. So if I had $100, I could take $50 of Apertum, I could take $50 of USDT, and I could add it to this pool. And if I add that to the pool, if I provide liquidity, then I position myself to earn from the fees generated in that pool. And these fees go up and down all the time. We've seen the fees go as high as 78% per annum. We've also seen it go as low as 8% per annum. So they're fluctuating the whole time. And up till now, people haven't really known how they can track what they're earning from this. Now, when people talk about how do I get my crypto to earn without giving away my crypto, these liquidity pools are one way to do that. So there's this new function that's been added in the DEX that actually shows in real time what someone is earning from the liquidity that they provided. So again, if I've got Apertum and I've got some USDT and it's just sitting in my wallet doing nothing, I can add them in equal value. So it's got to be $50 and $50 worth. It's got to be $20 worth and $20 worth. Or just be equal value. I can add them into one of these pools and it'll show me in real time what it's earning every day, every week, every month. Let me show you. I've got a wallet here. Hold on a second. I've got a wallet here. I can now see, and I've got like a couple of different pairs in here, but I can see I've earned $58 in fees. So people are buying and selling from my liquidity, and I'm earning money because I've provided the liquidity. This is hugely, hugely powerful. It means that you don't just have to sit on your crypto and wait for value. You can put your crypto to work. Now, we've seen this work exceptionally well in a decentralized exchange called Uniswap. Uniswap is 7 years old. It's one of the largest decentralized exchanges globally. No management of funds, no broker, no, centralized custody, none of that. Uniswap is moving in the hundreds of millions and people are getting fees for providing liquidity. PancakeSwap, the second largest exchange, decentralized exchange globally, same thing. And Apertum now has its own decentralized exchange as well. And I want you to think about it. We're sitting in the first 5-year window. Don't just think of that as the first 5-year window for the value of the coin to go up. Think about it as the first 5-year window where the infrastructure gets bigger. The number of traffic using the infrastructure gets bigger. The number of coins and tokens using that infrastructure gets bigger. The number of people buying and selling gets bigger. Well, those of us who are mining Apertum, we can now participate in the fee structure and earn 13%, 20%, 40%, whatever it is, it fluctuates. And in real time, those fees are generating that we can claim as we need them. Oh, here's another extra $100 that my liquidity has created through fees. There's another $1,000 that my liquidity has created through fees. I love the fact that blockchain has these two worlds, centralized and decentralized. And I love that if you're smart and you understand infrastructure, that there's a lot of value on the table in the decentralized space that people are not paying attention to yet. And we now have that unfair advantage of participating in it, making people aware of it, and positioning ourselves in it. This blockchain workshop is not about cryptocurrency. You can go into any central exchange and run through their academy. This blockchain workshop is about blockchain and infrastructure and how to accumulate value at the infrastructure level. You don't get more base infrastructure than mining. You don't get more base infrastructure on trading than a DEX. And we've got access to both. And then you look at the referral engine that's on marketing this out into the market. We got a community that's benefiting from growing its own community. Like, wrap that around your head. How many shareholders in a company are actively going out and promoting the company they hold the shares in? How many of them are doing that? Cryptocurrency flips it on its head by saying, well, if you hold the coin, if you're mining the coin, if you're providing the fees, it's in your best interest to also go out there and get more people using that infrastructure. It's in your best interest to become part of that marketing team. more people, more use, more growth, more infrastructure. We're going to be wrapping up this blockchain. I said 90 minutes. We're on 91. I want to thank you all for your time. I'm going to take 4 minutes now to answer any questions. For those of you who've been with me for 90 minutes, thank you. For those who've still got some questions, pop it into the Q&A box right now, and I'll have a look through them very quickly. Someone's asking, will there be a limit on the number of miners? There's no limitation on the number of miners. There's no limitation on how many people can mine Bitcoin. And ironically, it creates a paradox. We call it the dilution paradox. We saw it in Bitcoin mining. The more people you had competing for Bitcoin, the smaller share of that Bitcoin they were getting, the smaller increment they were getting. And because it was a smaller increment, they were no longer willing to sell it at $2. Now it only became profitable to sell it if it got to $20. The people who were mining it at $20 was only really profitable to sell it when it got to $200. And so it created something called the dilution paradox. It only ever happens with fixed supply coins, with emission models. And so it's good if we can increase the miner base, because it then decreases what we call fractionalizes the amount of coins being received. Dilution paradox. Joan's asking, where do we find the DEX? So Joan, I'm a big fan of the Explorer as the address book, right? The starting point for everything. And most people don't pay attention to the Explorer, but let me show you something here. Remember what I said to you, the Explorer is the open source accounting book. It's not just that, it's also the business directory. So take a look here. If you go to the dApps tab, dApp just stands for decentralized application. But if you click on the dApps tab, you get all these different dApps that you can identify. And inside of here, you'll find Apertum DEX. And so you click on Apertum, more info, launch app, and it then opens up. And mine is automatically connected to my wallet because my wallet's open on the extension. If I close that wallet, so in other words, if I come down to here and I disconnect, can't find the disconnect button, it's on here somewhere. Oh, there you go. If I lock my wallet, it'll then disconnect from the app completely. So that's a nice, easy way to find it. I like the Explorer. I like the dApp section. It shows everything that's connected, which is quite nice. Krisan's asking, would you say it's beneficial to put liquidity into more than one DEX, so someone Apertum, someone Pancake, and someone Uniswap? Look, again, this is my opinion, guys. This is my opinion. When you are taking liquidity and you're putting it into multiple places, you are diluting the liquidity that you have. It's exactly the same whether you are whether you're a coin that's trying to launch onto lots of exchanges. So people often ask me, but can we buy Apertum on central exchanges? Yeah, there's 8 central exchanges at the moment that are listing Apertum, have listed Apertum. There's more that are listing. My feeling on this is every time you take coins or value, liquidity, and you put it over many different places, you dilute liquidity. And so for my own personal strategy, I use the Apertum DEX, because then instead of me taking 1,000 and diluting across 3 DEXs or whatever, I'm putting it into one DEX. And so I'm getting 0.3% on a larger amount sitting inside of there. So that's the decision I've made. It could be different for other people. Maybe by diluting that liquidity, you're de-risking, and that's another strategy. So Chrisanne, I think it is a personal thing. I don't think there's a neat answer on that. I'm just giving you my answer. Right, that is more than 90 minutes. We're sitting on 95. So I want to thank everybody for their time. I hope you got value out of this. I hope it's given you a stronger foundation, solid infrastructure to understand what you're looking at. And I definitely want to encourage you, get onto short, sharp presentation calls with the community that you plugged into. Get onto short, sharp training calls with the community you get onto. It's always easier to do a 20 to 30 minute call on a specific topic in order to get information. And that's certainly where these communities that we have in Sweden, in South Africa, in the UK, in Texas, in Utah, in all these places where these communities are forming, plug into your community, get into little topic rich moments, whether it's on the marketing, whether it's on the product, whether it's on a promotion. That's the best way to learn. So I want to thank you for your time. Have an awesome evening, morning, afternoon, wherever you are, and take care.